Good morning, everybody. Sorry to keep everybody waiting. I was just finishing up on a call there. Hopefully, everybody's having a great Wednesday. Apologize again profusely for the technical difficulties 2 weeks in a row that we had on Monday. And we're doing everything we can sort of behind the scenes to ensure that won't happen again. We know that San Francisco, the bandwidth and the internet connection seems to be stable. So we're going to try and do everything we can to broadcast from here most of the time. And if we do have to go to another location, make sure that we're testing it out and making sure that ahead of time that it's going to be able to facilitate these sessions. So today is our Mastering Transactions. And we are going to be talking about having a basic understanding of real estate tax benefits. I know on the title of the training was tax benefits and consequences. And really, it's not consequences. It's more liabilities that we want to talk about in terms of what some of the liabilities for buying, for owning, for selling real estate are, as well as what some of the benefits are. Now, there's going to be a lot of disclaimers as we go through this, and please understand we are not presenting this so that you can go and tell all your clients. We're presenting this just so you have, again, a basic understanding of some of these rules, regulations, laws that will hopefully be able to give you a better understanding of how you can help the clients and then where to point them for the actual concrete legal answers to some of their questions or situations. Now, so again, we are in our Mastering Transactions session. This is every Wednesday from 10 to 11. We do also do Mastering Your Business on Fridays from 10 to 11. And that's everything that will hopefully set the foundation for building a productive year and career in real estate. And then Mondays, we do Mastering Contracts, everything contract disclosure, document related to doing business in real estate. So those are Monday, Wednesday, and Friday, always from 10 to 11. In addition to that, we do offer a 90-day calendar in which Monday through Friday, every single day, sometime between 6 and 7 a.m., we will send you a new task. With that task, we will give you all the things you'll need to hopefully complete that task, including videos, links to web pages, step-by-steps, how-to guides, all of the information, like I said, that will allow you to achieve that task. And with that task, set the foundation for, again, building your business into a great 2026 and eventually a wonderful career. So with all of that being said, if you are currently receiving those, fantastic. I hope that everything is going well. If you are not and wish to receive those tasks, simply drop your name and email address into the chat, and we will go ahead and get you set up. So I'm not sure. There was one person that did drop their name into the chat on Monday that when I got kicked off one of the 3 times, I lost. So if you are on here and wanted to get that, you were on Monday and you were the one that put your name and email address into the chat, please do so again, and we'll make sure we'll get you set up. For everybody else, let me go ahead and share my screen and we will get started. As always, we will put this slide deck into the chat once we are done. Please don't be too intimidated. This is a huge slide deck. It's 35 pages. We're going to go fairly quickly through these pages. And again, just give you kind of a brief overview of all the things tax related to real estate. And again, hopefully make it so that you just have a basic understanding and can better help your clients. It is, with all that being said, it is a ton of information in a very short amount of time. So nobody's expected to memorize this or anything of that sort. The fact is, what we're really trying to do is just make you aware of a lot of these different tax benefits, consequences, liabilities, whatever they might be. But we really encourage you to go out and make the connections with a financial advisor, a CPA, a tax attorney, an estate planner, somebody that can actually legally give advice on these matters that you can have at your fingertips to refer to your clients. Okay. Ultimately, if you get nothing else out of this today, is go out and make those connections. Okay. Have somebody at the ready, okay, at the push of a button, a dial of a number, that is going to be able to answer all of these questions legally. Okay, so you can see here, this is basic understanding of real estate tax benefits and consequences. This is for internal use only and for agent education purposes only. You're going to see this probably on most of the slides. We're just trying to have that disclaimer, okay, that we are not qualified unless you are a CPA or an attorney or a professional tax advisor. Most of us are not qualified to give advice on any of these things. Okay. Now we do have to have a little bit of an understanding to know how and when these might apply to our clients and when we should encourage and or strongly advise them to talk to a professional to get the legal standing that they may need. Okay, so let's jump into this. Again, it's a lot of slides, but we're going to go quick. So again, disclaimer: presentation is education purposes only. Nothing in this presentation constitutes legal, tax, accounting, or financial advice. We are not licensed tax advisors. We always want to refer clients to qualified CPAs, tax attorneys, financial advisors, like we just said. Tax laws change frequently. Okay, so it's one of those that the information that we have today may change July 1 with new laws, or in 2027 or 2030 or whatever it might be. Okay, so the information we have now is the most up-to-date that we could find. Okay, and client-specific tax situations vary. Okay, never apply general rules as definitive advice for any individual. Okay, when in doubt, refer it out. Okay, best advice we can give. So why does tax knowledge matter for real estate agents? Okay, first, it's so we can build client trust. Okay, clients rely on us to speak knowledgeably about tax implications. Okay, now we can't give advice, okay, but we can have some background information that we can have an understanding of, that if we think it may apply to those clients, then again, get in touch immediately with a person that would be able to legally advise them on these situations. It may help avoid costly surprises, okay, at the close of escrow, realizing that they have a big tax bill that has to be paid. Okay, or a close of escrow on the sale. Okay, they didn't realize when they purchased it that when they sold it, they could have tax consequences. Okay, so these are all things that we have to have a basic understanding of to help our clients. Okay, strengthens our referral network. Like I said, if we take nothing else but the fact that we need to go out and make connections with a CPA, a tax attorney, an estate planner, a financial advisor, okay, that is going to benefit us in the long run. Not only us referring clients to them, but hopefully eventually them referring clients to us. Okay, it's going to help us navigate complex situations, divorces, inheritance, 1031 exchanges, downsizing, estate sales. These all have different tax consequences or benefits. Okay, so knowing a little bit about these will help advise the clients if it may or may not be a good time to buy or sell. All right, so hopefully staying in our lane, knowing the basics, helps us recognize, okay, when our role ends, okay, and when a professional advisor begins. Okay, protects us, protects the company, protects the client. Okay, and then hopefully allows us to close more deals. Okay, if a client thinks that a door is shut, okay, and we have a basic understanding of some tax rules that may open that door for them, okay, that's going to lead to more deals for us. So, first thing we're going to talk about, property tax. Okay, how property tax works in California. So property tax in California is administered on the county level. Okay, each county collects annually by the county tax collector. The core formula for California is your base rate, which is typically your purchase price, times 1% of the assessed value. So, and your assessed value is typically your purchase price at the beginning. Now that may increase over time, and we'll talk about that in a few minutes. Now, there's a lot of local add-ons, okay, which are typically voter approved to our base property tax of 1%. Okay, and those are bonds, assessments, Melrose, things of that sort. And it usually brings the tax rate to between 1.1 and 1.3%. Okay, as a general rule of thumb, most estimates are for about 1 and 1.25%. Okay, that's just a kind of general rule of thumb in terms of what the property tax is. And again, that will be based on your purchase price, okay, plus annual increases, which again, we'll talk about in a little bit. There's 2 installments of property taxes, okay? They're due on November 1st and then delinquent after December 10th, okay? And due on February 1st, delinquent after April 10th, okay? And it's funny that they've got those due on delinquent after, okay? Because everybody associates, I pay my property taxes. I know it's December 10th and April 10th, okay? I don't know anything about the actual due date, okay? I just know when it has to be paid. So the way property tax works is you purchase a property, the county assessor sets the value, and that's typically based on the purchase price. Now, we talked about there are annual increases, but Proposition 13 in California limits those increases of the assessed value to 2% per year. Okay, so every year your property taxes, in addition to the add-ons in terms of the bonds, assessments, Melrose, is going to go up, but it's also going to go up slightly every single year. Okay, but it is capped at 2% per year. Okay, the annual bill is mailed out by the county. 2 installments are billed. Okay, and the taxes paid to the county fund the schools, infrastructure, local services, so on and so forth. All right, so again, if we are just looking at a quick down and dirty generalization of what the property taxes are for somebody buying a house, it's typically going to give you about 1.25% times your purchase price. Okay, now a lot of people have impound accounts set up so they don't even see or know when property taxes are paid. Okay, they pay a monthly installment to an impound account, and then that's paid annually to the tax assessor. So we talked about Proposition 13, meaning capping the amount that taxes can increase per year. All right, so it was enacted in 1978, and it basically sets your purchase price as your base year value. Okay, the annual increase can be at 2% per year, regardless of how the market actually grows. Now that's something to note. Okay, in California, our markets typically are always growing. However, you can have a reassessment or ask for a reassessment if the markets are depressed and your property values go down. So that's one thing to know as well for your clients who are homeowners. If we are ever in a market that has an extended period of decreases or stagnation, okay, and their property taxes keep going up, and up, okay, they can actually look to reassess those. So if their property value is dropped below where they purchased, okay, they can ask for a reassessment. Okay, it doesn't guarantee they'll get it, but they can ask for it. Okay, now they will also get a reassessment once they sell the property and the new buyer takes ownership. But there's also a couple of things that trigger reassessments. Okay, and that's if you have new construction. Typically, if you build or increase square footage by more than 50%, you may get a reassessment. Okay, certain ownership changes also reset the base, okay, to current market. All right, so proposition protects long-term owners, all right, which is why some clients are hesitant to sell their low tax home. All right, they're not just selling a property, but they're giving up a tax advantage they built over decades. Okay, and we're going to look at some ways around that as we get further into this. All right, so just some real world examples. Okay, this is Maria, who purchased in 1995 for $200,000. All right, today's market value is $900,000. All right, but under Proposition 13, okay, the assessed value for Maria's home is only $370,000. Okay, because they take the $200,000. Okay, 2% increase per year only puts it to $370,000. All right, so without Proposition 13, All right. Maria's initial base tax could be 99, almost $10,000. With Prop 13, it's only 4. Okay, so Proposition 13 helps homeowners keep their tax bills affordable. Now, in California, saying affordable is, definitely something that we take with a grain of salt because really nothing is affordable here. So we just talked about Proposition 13, Proposition 19. Okay, well, Proposition 19 came in 2021. And this changed a lot of different rules in terms of tax bases and in terms of for transferring to family members, and tax bases in terms of keeping your tax base if you buy another property. Okay, so there's 2 things here with Prop 19. We won't look at what was pre, we're just going to look at what it is right now. So right now, if you have a primary residence, okay, and you give that primary residence to your child, okay, as long as your child occupies that primary residence as their primary residence, okay, they get to keep the same tax base that you had. All right. Now, there is some exclusions in that it is capped at $1 million of reassessment, meaning that if you bought the property for $100,000 and it's now worth $1.5 million, okay, only $1 million of that can be excluded from the reassessment. Okay, now unfortunately, investment and rental properties can't be passed down without reassessment. Okay, prior to 2021 they could. All right, but any investment properties will now be reassessed if you pass those down. Now, there's other ways around that. And again, that's why they should talk to a qualified tax professional and or an estate planner, because they may be able to alleviate some of those tax consequences by restructuring the estate, okay, putting things in trust and things of that sort. So the other thing that Proposition 19 changed was that if you are 55 years or older, okay, you are allowed to sell your property, okay? And as long as the property is or was in the same county, okay, or part of 9 other counties that cooperated with your county, you could keep your tax base as long as you purchased for equal or less than you sold for. Okay, now they say that you can do that statewide no matter what. Okay, if you're 55 and older and you sell in San Francisco, you can go down and buy in LA, okay, and keep your tax base that you had here from when you purchased in 1990. Okay, now there are a number of requirements, okay, that allows you to do some of these things. Okay, so parent to child transfers to keep the tax base. Okay, parent passes away. Child within 1 year has to file a claim that says that the property's been passed down and they're going to live there. Okay, the assessor was actually going to look at what the market value is, and as long as the difference isn't $1 million, okay, then the child gets to keep the exact same tax base. Okay, if the difference is over $1 million, then it'll be a partial. Okay, they'll keep everything up to $1 million, and then anything on top of that is going to be reassessed. Okay, but again, the only way to keep that tax base is for the child to live there. Okay, now the other scenario we talked about, if you're 55 years or older, okay, at least one spouse, all right, you get to sell your property, all right, then you get to purchase another property anywhere in California. Okay, and as long as it is equal or less value than you sold for, there is no additional tax consequence. You keep the same exact tax. Okay, much like that $1 million rule for the inheritance. Okay, if you buy a property for more than you sold for, then you're going to be responsible for that difference. Okay, so real world scenario, just like we talked about with Maria a little while ago. Let's say you're 55 years or older and your current assessed value is $200,000. Okay, but the market value is $800,000. All right, You sell for 800, but you buy a new home for 850. Okay, so you have a $200,000 base, okay, but you have a $50,000 difference. So essentially, your new assessment is going to be $250,000, okay, instead of the actual full purchase price of 850. Okay, so in the past, you couldn't transfer even if you were 55 and you bought within the same counties. Okay, if you bought for more than you sold for, there was no way that you could transfer any tax base. Now they allow you to do that. Okay, this is still considered downsizing to a certain extent. Okay, you're just paying taxes on the difference. Okay, so this helps for people who've been in their homes and maybe are retired. Okay, their home might be paid off, and they're looking at the fact that, yeah, I can sell my house and I can go buy a new one. But if I do that, instead of paying $2,000 a year in taxes, I'm going to pay $10,000 in taxes a year. Okay, so this helps with those clients that think that their expenses are going to go way, way up if they decide to move. Okay, if their house is paid off and they sell for $1 million and they buy for $1 million. Okay, there is no out-of-pocket expense, hopefully, for the purchase, and they keep the same exact tax. Okay, maybe they get to a house that has no more stairs, or they move into a condo so they don't have to upkeep, or whatever it might be. They move closer to the grandkids. Okay, as long as it's in California, they're allowed to do it. Go ahead, Long.
Oh, hi, Romeo. Yes, how are you? Got a question for you. So let's say a family, um, let's say the parents, of course, they are over 55, and then the child is under 55. So how this scenario work? Let's say if they
As
sell,
long as long as as long as one person on title is 55 or older, it qualifies.
okay, so even though they own 50/50 of the property,
Yep.
oh, so they can do the whole thing transfer over.
Yep.
Oh, got it. Thank you.
Welcome. So next thing, capital gains. Okay, and this is one that you're going to hear a lot about, and most people don't have a good understanding. I don't have a good understanding of capital gains. I know what it is. I know how to talk in real basic terms about it, but I also don't know what the actual consequences are in terms of the amount that somebody is going to be responsible for at the end of the day. So I know what the rules are, okay, but this is definitely something that's way outside my lane, and something that, again, I can talk about some basic rules and give my clients an understanding that may help them decide to purchase or not purchase, or sell or not sell. Okay, but ultimately, I know that I need to refer them to a tax person, okay, to talk about what the actual consequence may be. Okay, now I also know that there are ways around capital gains that I can help them with that are going to lead to a lot more transactions. Okay, and we'll talk about those in a little bit. So, capital gain is the profit from the sale of an asset, like real estate. Okay, basically, the formula is your sale price minus your adjusted cost basis is the capital gain. So, what is the adjusted cost basis? Well, that's your purchase price plus any capital of improvements plus your acquisition cost minus any depreciation. Okay, so those are all a lot of words in theory. So what does that mean? It essentially means what you bought it for, any money you put into it to capitally improve it. Okay, your acquisition cost, meaning commissions or any things of that sort, and then less any depreciation, which would have been filed on your taxes. Okay, again, way outside of our lane to talk about depreciation. Okay, but that's the formula for it. One thing to know is that if you took a loss, okay, and that's, investors a lot of times will take losses on a monthly, yearly basis, knowing they're going to make it up, okay, on their taxes and or when they sell the property. All right. So again, that's something they need to talk to their financial advisor, their tax professional about. So, and not all sales create a taxable gain. So there are some exclusions. And again, that may include, offsetting or deferring your taxes. Okay, so a taxable gain formula is your sale price subtracted by your original purchase price, subtracted by any capital improvements that you did, subtracted any sales costs, and then depreciation. And that is your taxable gain. Okay, so remember, we help build a rough picture, but we always, always, always want to refer them to the proper professional to actually give them the details and the actual dollars and cents. Okay, so basic rule for capital gains, okay? And this is on primary residences, okay? So that's very important to note. The basic rule is that a single person can write off tax-free $250,000 worth of gains. Okay, a married couple who filed jointly, okay, can write off $500,000 in gains. Okay, this is one of the biggest tax exclusions available to taxpayers that the IRS has. Okay, meaning that if you are a single person and you buy a property for 250 and you sell it for 500, okay, obviously with all of the other costs, your gain is going to be less than 250, okay, but you get all that tax free. Okay, if you're a married couple and you buy for 250 and sell for 750, you get that 500,000 tax free. Okay, now the caveat to that is you must own and use that property as your primary residence for at least 2 out of the last 5 years. And again, this is where your tax professional comes in, because when they're filing your taxes, okay, they are filing what properties are your primary and or your investment properties. Okay, those 2 years don't have to be consecutive. Okay, they can be broken periods within the 5-year period. All right, and technically every 2 years, because again, you have to live in it for 2 out of the 5. Okay, technically every 2 years, you can use this rule. Okay, if you're buying and or selling on a regular basis. Okay, now you can also get a prorated or a partial exemption. Okay, if the 2 and 5 doesn't years isn't fully met. Okay, and again, that's your tax professional coming up with those things. All right, so just as an example, if Jim and Sarah bought in 2016 for $500,000, okay, they sold in 2024 for $1.1 million, okay, they have a rough gain of about $600,000. Okay, the 121 exclusion, that's what this is called, allows them to take $500,000 tax-free. So effectively, they only have $100,000 in taxable gain. Okay, so hopefully those numbers, are general enough to make sense. So one thing to know is that 2 and 5 years, okay, that would encompass what's considered long-term capital gains if there's anything over that. Okay, there's also short-term capital gains if you hold the property less than a year or 2 year, or live in it less than two out of 5. Okay, and they're taxed differently. Now, again, this is not something that we want to dig too deep into, but we just need to know that if somebody holds a property for less than 2 years, their tax consequence may be a lot higher than somebody who holds it for 2 or more. Okay, and that goes for primary and investment properties. So in terms of, there's also, that was just federal. Okay, California, all right, also has capital gains. Okay, and they don't care if it's primary and or investment property. Okay, and rates can go up to 13% on the California side. So one thing to note is that, again, some of the pros and cons of owning property and living in California is that we're not only subject to federal capital gains laws, okay, but you may be subject to state laws as well. So again, tax professional, they'll be able to detail all of those. And a lot of times, if somebody's working closely with their tax professional, the tax professional may tell them, if it's late in the year, you know what, you need to buy or sell something before the end of the year, or you're going to get killed on taxes. Or vice versa, they may tell them, you know what, it's October. If you wait till January 1 for this purchase, you're going to be a lot better off in taking advantage of some tax benefits for the whole year, as opposed to doing it late this year. So that's something to note as well. Now, 1031 exchanges, okay? This kind of gets tossed around a lot without much explanation, okay? 1031 exchange, or a Starker exchange, is basically when somebody sells an investment property, okay, uses the funds that they make on that investment property to buy another or more investments. Okay, so there's a couple of things to note. First is it must go through what's called a qualified intermediary, meaning that if you sell a property or your client sells a property and they want to exchange it, and the reason for that exchange is not to eliminate taxes, but what it does is it defers taxes, meaning that if somebody was going to sell a property today for $1 million, okay, and it's an investment property that they bought for 500, they're going to have capital gains on $500,000. Okay, in order to, and again, this doesn't eliminate it, but to postpone paying those capital gains, they can buy another property or multiple properties, okay, for equal or more than they sold for, in which case they can defer any tax consequence. Okay, and this is a way it basically kicks the can down the road. Now, there are ways after doing these exchange, okay, to turn the property into a primary residence, all right, and then take advantage of the $250,000 and $500,000 tax-free, okay, and you'll find that people who build a lot of wealth really look into and plan ahead to take advantage of a lot of these tax benefits. Okay, so if I know that I have an investment property and I'm going to, in let's say 5 years, retire to Florida, okay, I might sell my investment property here in California, buy an investment property in Florida that I know I'll move into in a few years. Okay, I defer my taxes, all right, rent it out for 2, 3, 4, 5 years, and then I'm going to go down there, I'm going to move in. All right. And in 2 years after I move in, I'm going to sell it. And I'm going to take $500,000 with my wife, tax free. Okay. So it's one of those that, they're doing a 1031 exchange may be just the first step of a number of steps in tax benefits down the line. Okay. So the owner, the seller, and then the buyer can never touch the money. Okay, if it goes to them in the form of a check or a wire, even for 1 minute, 1 day, 1 hour, all right, then they may lose the ability to defer those taxes. So it has to go through, again, a qualified intermediary, which is a dedicated company that handles these type of exchanges. Okay, if somebody is doing an exchange, once they close escrow on the sale of the first property, they have 45 days to identify the property that they are going to purchase. Okay. And within 180 days of closing on the sale of that first property, they have to close escrow on the purchase or purchases of the replacement properties. Okay. So 2 things to note in terms of timeline on 1031 exchange: 45 days to identify, 180 days to close. Okay, as long as you do that and do it through an intermediary, you can avoid the capital gains. You defer them. Okay. One of the things to note is that they always say it's a like-kind exchange. And a like-kind exchange doesn't mean you're selling a single family and buying a single family, selling 2 units, buying 2 units. Like-kind just means that it is a investment property. So you can sell a 3-unit building, okay, and as long as you purchase a single family home for equal or greater value, that's perfectly fine. Okay, you can sell a single family home and buy 3 2-unit buildings. Okay, as long as no money changes hands, again, the total value is equal or more than you sold for, perfectly fine. Okay. So just some basic things to note. Boot is basically the amount of money, okay, that is effectively the money that cash boot is keeping any cash from the sale proceeds instead of reinvesting all the equity into replacement property. Even $1 triggers taxable boot. So if you take any money, even if it's $1, you may have a tax consequence. Okay, mortgage boot, taking on less debt on the replacement property, okay, is a reduction in liability, is treated as taxable as well. And then personal property boot, receiving non-real estate items as part of the exchange, okay, is also boot subject to taxes. So depreciation. Now, this is where things get really complicated, and we as realtors, okay, probably don't need to dig in too much in terms of being able to, discuss this too much with clients. Again, this is really up to their tax professional, their CPA, their tax attorney, in terms of how this is going to work. But effectively, when you have an investment property, okay, you can depreciate that property, okay, and take tax credits, okay, when you file your taxes each year. All right. The federal government allows us, if you have a residential rental property, okay, to depreciate that property over 27 and a half years. If it's a commercial property, you can actually depreciate it for almost 40. It's 39 years. Okay. And it's the building itself that depreciates. Okay. Normal wear and tear, maintenance, things of that sort. Okay. So even if the property is appreciating in value, okay, you can depreciate the actual asset itself. Okay. And depreciation is the reason that investment properties can actually be a positive cash flow, even though they show on paper you're taking a loss. Okay, so if you're taking a loss, let's say of $100 a month, $1,200 a year, the tax benefit that you're going to get from the depreciation that you're going to write off so far exceeds that $1,200 loss. Okay, you're going to come out ahead. Okay, so the way it works is, let's say you purchase a property for $550,000. Okay, the land is worth 100, so it's a $450,000 real estate structure. Okay, as we mentioned, 27 and a half years is what the IRS allows us to depreciate it over. So effectively, it's a little over $16,000 a year that we can write off as depreciation. Okay, so over 5 years, if you hold the property for 5 years, you can write off over $80,000, okay, in depreciation. So again, even if you're taking a small loss, we had a rental property here in San Francisco. It was 3 units. And effectively, we tried as best we could, okay, to make sure that we took a small loss every year on it, okay, whether it was from maintenance, whether it was from the rents, whether it was from utilities, things of that sort, okay. Now, we didn't want to come out of pocket too much, but effectively, it was about $200 a month. So we spent about $2,500 a year. We took a loss on that rental property, okay, but we also wrote off, it was $25,000 each year in depreciation. Okay, so we made up for our loss each month at the end of the year. Okay, so rather than having a big tax bill, because if you make money on investments, that's taxable income. Okay, on rents and things of that sort. Okay, so this worked well for us, and it's something that we worked really hard with our tax professional on to determine how to structure that. Okay, so again, if you're looking at, let's say, investment properties for your client, and they're looking at just rents, saying, well, those rents aren't going to cover my expenses. Okay, well, they may not need those rents to cover their expenses. Okay, we may not have to cross that one off the list. We may need them to talk to their tax professional and see if that actually makes sense, okay, in the long run, okay, over a year, 5 years, 10 years, the life of the property. Okay, so that's one of the things that we need to understand and know, that depreciation exists and may help the buying power of our clients. Depreciation recapture, we're not going to talk about that. That's getting really into the weeds in terms of when you sell the property, you may have some tax liability. Again, that's for your tax professional to really talk about and discuss. So, talking about inheritance, okay? This is one you may hear, and again, we get questions on all the time, stepped up basis. Okay, what exactly is a stepped up basis? Well, a stepped up basis is when somebody passes away, okay, and a property is passed down or inherited or transferred to the remaining spouse. What happens is the cost basis for that property gets bumped up to whenever that life event happened. Meaning, if somebody bought the property for $100,000 and unfortunately at their demise, it was worth $1 million, okay, and the property passes down to their kids, okay, well, the kids get a stepped up tax basis of $1 million, okay, and that's in reference, that's not for property taxes, that has to do with value and capital gains, okay, meaning that if somebody inherits the property and it was worth $1 million at the time of their inheritance, when they sell it, okay, the capital gains calculations are going to be based on that stepped up basis. Okay, that also happens when one spouse passes, the surviving spouse gets a stepped up basis. Okay, so it allows people who have owned their properties for years and years and years to avoid some capital gains. Okay, if unfortunately somebody had passed away. And this is just different ways of holding title. If it's in a trust, you don't have to go to probate. If there's a will or no will, okay. If there's a will, it does require probate, but it may not require the court to be involved with a confirmation. If there is no will, if it's intestate, then it's a court ordered and has to go through court with approval. Okay, so it doesn't necessarily apply to taxes in this sense, but it does in a roundabout way in terms of the inheritance, things of that sort. Now, the big one for people who are buying property, personal property, and living in it and owning it, okay, the biggest thing for them, and this is where like the calculator from rent versus own comes into play, in that every year that somebody owns a property and lives in it, okay, they get to take deductions for their interest they pay on their mortgage, as well as property taxes. Okay, so the deductible on mortgages is only up to $1 million, okay, if it is prior to 2017. For anything after 2017, it's only up to $750. Okay, has to be the primary residence plus a second home. Okay, that does qualify. And it only applies if on purchase loans, or I should say, purchase loans or refis, not on home equity loans. The home equity loans can be written off if the funds are used to build or improve the property. Okay, and it must be on an itemized deduction on Schedule A, which again is way above my pay grade. But again, this is something that we refer out to our tax professionals. Okay, that's the mortgage interest. Now you're may hear something called SALT deductions. Okay, and that's state and local taxes. Okay, and there's a cap on that every year of $10,000. Okay, that includes state income tax, sales tax, property tax, all of those type of things. Okay, so there is significant tax benefits to owning your own home. Again, if somebody's paying rent of $5,000 and mortgage of $7,000, they may look at it as, you know what, that $2,000 doesn't make sense. Okay, but if we look at it in terms of being able to write off that mortgage insurance, your property taxes, all of the things that go along with home ownership, okay, that $2,000 that you're saving, okay, each month, okay, may not pay off in the long run in terms of your tax consequence. Okay, not to mention building equity and all of those type of things. Okay, so it's not as simple as just what your rent is versus what your mortgage is. There's a lot that goes into that. Okay, so what are the things that are deductible? Mortgage interest, as we talked about, property taxes, insurance, okay, management fees, if you have any repairs and maintenance, your CPA, your attorney, your bookkeeper, the person that's actually preparing your taxes. Okay, now you can write that off. Okay, advertising and leasing costs, depreciation. We just talked about depreciation if it's an investment property. Okay, travel to inspect the property. Okay, HOA dues possibly. All right, so a lot of different things that maybe most people don't think about in terms of being able to save money in the long run okay, vis-a-vis a little bit more in the monthly output in terms of your mortgage versus rent. Short-term rentals, that's really getting into the weeds. We're not going to really discuss that much, but you can definitely go back and take a peek at that later. Want to talk about who to refer things to and why. Okay, and we're almost done here. Again, I know it's a lot of information to process. These slides will be in the chat once we're done, so you can go back and refer to them. And again, if nothing else, hopefully this opens your eyes for the need, okay, to reach out and connect with a CPA or tax advisor. Okay, now when should we reach out to them? We should reach out to them right now, so we have them at the ready. Okay, but if and when your client, okay, needs to know about capital gains, need some calculations done. Does it make sense to sell right now? Does it make sense to wait until next year? Okay, does it make sense to buy and cash out? Okay, I've got a seller right now who understands that if they sell, okay, they are going to have significant capital gains consequences. So what we did is we referred them to their CPA. They did have one. They sat down with the CPA, and the CPA said, you know what? The money that you're going to make, okay, less the capital gains, what you're going to do with it in the long run, the plan you have actually makes more sense than reinvesting or putting this into another property. Okay, so for them, it made total sense. Okay, last year, we had a seller who was in her 80s who just didn't want to deal with real estate anymore and said, you know what? Yes, I'm having to pay capital gains, but look at all the money I've made over the 5 decades that I've owned this house. It's much more than I'm having to pay in gains. And that's okay. Okay. I need this money to basically fund her retirement and do the things she wanted to do. She was okay paying it. Okay. And that may be the case in some cases. All right. So if your client doesn't know anything about depreciation, okay, they haven't depreciated their property, they file their own taxes, they go to H&R Block, all right, and they do the very basic. Okay, well, maybe now it's time to talk to a real estate professional and see if there's some other tax benefits you're not taking advantage of. Okay, if there's a 1031 exchange that needs to be done. Okay, rental income optimization. It may be that it's time to raise rents, but if we raise rents, that's going to mean income to the client, which may be more of a tax consequence than a benefit to them. All right. So they'll handle federal and state tax returns, long-term tax strategies, and audit representation and support should the client need it. Okay. We also want an estate or probate attorney. All right. And it may be time for your clients who have a lot of real estate holdings to look at putting those real estate holdings into a trust. Okay, we may have a client that contacts us and says, yeah, my mom or dad or aunt or somebody I know just died and I want to sell this property. Okay, well, the first question should always be, do you have an attorney? Okay, if not, let's get you in touch with one to see A, what your rights are, and B, what the rights are for the estate. Okay, Prop 19 planning. If you're 55 years old or older, or the property is going to be transferred to a child. Okay, inheritance issues, capacity questions, meaning mental capacity, and or if somebody is fully fit to act on their own behalf. Okay, qualified intermediary. We talked about that a little bit. That would be your 1031 exchange company. Okay, most title companies have an affiliate 1031. Okay, so when in doubt, reach out to your title rep. They'll be able to refer you to the company that they use. Okay, and then a financial planner. All right, now this may be something that you want to refer your client to early on. We actually have a financial planner here in our San Francisco office. He's a financial planner and also a real estate agent. But a couple of our agents here in San Francisco, they actually give a consultation with him to their clients as a closing gift. Okay, and he'll be able to help them set the foundation long term. Okay, especially for first-time buyers, is something that's fantastic. Okay, so something we want to do is have a short list or 2 or 3 professionals within each of these categories that we can reach out to, again, at a moment's notice. Okay, maybe even get on a 3-way call with our clients. okay, to help them answer the questions they need now that'll help us, okay, close more deals. So some just quick scripts. Instead of telling a client they may not have to pay capital gains, okay, we want to say something of the effect of, Section 121 of the IRS code excludes or may significantly reduce your taxable gain. Okay, your CPA or tax professional can confirm this with the exact amount. Okay, let's get them on the line. Okay, don't tell somebody to do a 1031 exchange to avoid the taxes. Okay, we want to say a 1031 exchange may allow you to defer some taxes. Okay, we can get a qualified intermediary on the line, and them and your CPA should be able to come to the determination if that's possible or not. Okay, we don't want to say your kids won't owe anything when they inherit the property. Okay, we want to say heirs often benefit from a stepped up basis. Proposition 19 changed that a little bit, but an estate attorney can walk you through the specific needs for your situation. Okay, so on and so forth. So we just don't want to make any absolutes. Okay, we want to let people know we have an understanding of what might benefit them tax-wise. Okay, but always have the language that we're going to refer them or we're going to get them in touch with the proper professional who's going to help. Okay, and then finally, some red flags as well as some definitions. Okay, again, we don't expect anybody to commit all of this to memory. We don't expect you to be experts on any of that. We don't want you to be experts on any of this type of stuff. Okay, what we want is basically you to have a basic understanding of the different situations, have a few talking points, and then have the resources for your clients that's going to allow you to put them in touch with the proper professional that can answer their questions, that can advise them on the best steps, and then hopefully that's going to allow us to help them purchase and or sell, okay, more properties. With all of that being said, I'm currently putting this slide deck into our chat for everybody to download. But what questions, comments, concerns does anybody have?
Oh, hi, Romeo. It's Hong again.
Go ahead, Hong.
Yeah, so for the step-up basis, right? So the parents, of course, one spouse pass away, then they step up to the other spouse. Now, the last spouse, when the so for the last step up, does the inheritance have to have a name on the title or no? Do you know?
Say that again with title.
So on the last step up, right? Because spouse, husband and wife, let's say one pass away and then step up to the spouse, and then the last spouse pass away, then the last step up, does the inheriting person need to have a name on the title of that property or no?
No, well, so there's two things involved there. If they are going to want to keep the actual tax base and live in the property, okay, yes, they're going to have to be on title, okay, and or it stays under the estate's name, which is fine until they sell the property. Now, if and when they're selling the property, no, they don't have to be on title. They just have to fill out a form that it was a stepped up basis and they inherited the property. And that's all handled through escrow.
Unstable internet. Okay, hold on.
So, other questions, comments, concerns?
Yeah, hi Romeo, this is Jason.
Hey, Jason.
Question about Proposition 19. So, should Proposition 19 questions always be directed to an attorney, or is there a time to direct them to someone in the county? And if so, to whom do you direct them in the county?
So, yes, you can definitely direct them to the county, and that would be in the assessor's office, because that's where all of the tax forms and everything originates. So it would be the assessor, and in some counties, like here in San Francisco, it's the assessor recorder's office. It's one and the same. So I can't, exactly say for every county they have the exact same name, but in most cases it's the assessor. Trying to get a hold of somebody, especially in major metropolitan areas, might prove to be difficult, and they won't give actual legal advice. they'll basically tell you what the city and county allows, but they won't tell you if that applies to each individual or not. That you would have to go with the proper professional.
Okay, thank you.
Sure.
Hey, so Romeo, can you repeat the answer again? Because I got bad connection. I couldn't hear your answer first.
Answer for your question or the Jason's?
My question, yeah, the step up.
So the answer to your question, two different things. If after the last stepped up basis in the inheritance, so the child is taking the property, if they want to take the parent's tax base and live in the property and pay the same tax rate, though they're going to need to be on title. Okay. If they're selling the property, then all they have to do is fill out forms with the escrow company stating that it was an inheritance and a stepped up basis, and that's all taken care of at closing.
Got it. Thank you. Thank you.
So, other questions, comments, concerns? Again, hopefully this gives you just enough information to have an understanding, but also a little bit of a fear that you're going to want to go out and make sure that you connect your clients with the proper professionals, okay? Because it's one of those that, yes, have a basic understanding can help us find more deals, okay? But it also can get us into a lot of trouble, right? If we give standalone advice on any of these situations rather than referring this out to the proper professionals. So I'll take any more questions, comments, or concerns. We do have a couple of minutes, but just want to remind everybody, every day, Monday through Friday for 90 days, we send out a new task. With that task, we give you a how-to, a step-by-step, a link to an article, a video to watch, everything you'll need in order to complete that task. And if you're currently receiving those tasks, wonderful. I hope it's going well. If you're not and you wish to, put your name and email address into the chat, and we will go ahead and get you set up this coming Monday for our next session. I see Monica put her name in there. We'll go ahead and make sure you get set up on that. In addition to those tasks, every Monday, Wednesday, and Friday, standing appointment 10 to 11. Mondays, we're always going to talk about something contract related. Wednesdays, we're going to talk about something transaction related, and Fridays, something about building your business. So this is our agent development pathway that we have in place, and hopefully everybody's enjoyed today's class. Again, the slide deck is in the chat, so go ahead and download that.